Cap rate expansion, certainly a risk. Cap rates is the main metric used to value multifamily properties. And if cap rates increase, we certainly could see prices decline. We also can see cap rates expand and prices still go up, though. If cap rates are rising, it typically means we are in an inflationary environment. And inflation means continued rent growth. So we may see cap rates move up, while at the same time, rents are moving up, top line revenue is growing. And so we may more see flat or, little price growth kind of in a non-ideal environment. But it's something we have to pay attention to because cap rates are at absolute all-time lows. I think we're going to see probably average cap rates in the United States below 4.5%. I can see even 4.25% for this year. And there are many are projecting we could be at 4% or below 4% next year. This is a correlation between cap rates and BAA rated corporate bonds. And the reason why we're showing this is because it's one of the metrics that actually is somewhat correlated to cap rates. So I think it'll be important to watch some of the corporate bond yields compared to cap rates. Then also, again, looking at this yield spread, there's not a clear correlation between cap rates and interest rates. As we looked at recently, there's not necessarily a correlation between interest rates and returns because those aren't the only two variables. You have your business plan adding value, forcing appreciation. You also have all the organic growth that is occurring during those periods. And so even back in, and I remember this, we were investing in a lot of apartments at this time between 2016 and 2018, where we saw interest rates rising. We still saw solid apartment returns, and really the cap rate continued to go down as interest rates rose. And the amount of investor demand currently in the market, which we'll get to in a second, I think that will also offset that. And again, just looking at these returns compared to interest rate environments, there's not a huge correlation. Another reason I think cap rates are going to stay low, however, is just the amount of money that is looking to be placed in multifamily assets. There's currently a record dry powder sitting on the sidelines. This is just already pre-committed capital, basically $250 billion ready to deploy into apartments as soon as they can find the right opportunity. This will most likely keep apartment values buoyed up as the alternatives of investment are just not as ideal as multifamily, and more institutions, family offices, high net worth individuals, and just anyone is looking to allocate themselves to these real assets that track inflation. You can imagine there was interest in multifamily prior to this inflationary environment. Now that we're in an incredible inflationary environment, multifamily just looks like much more, even more appealing. So how do we mitigate and adapt for cap rate expansion? It's such a macro force; it's very difficult to do. But one thing is to invest in more stable markets, maybe more linear growth markets, not exponential growth markets. Some of those markets that have grown so much that if something happens, they could really correct. Whereas if we haven't seen a hockey stick curve, there's less to correct and we can predict a little bit more. Forcing appreciation is another way we can mitigate risk, because by forcing the value, we just have more cushion and more equity build up than if we were just kind of letting the property, grow on its own. And then I think the most important way to mitigate and through adapting is the ability to hold long. Now, it may be more beneficial to dispose of an asset, after 3 to 5 years of holding it, if market conditions are appropriate, get a higher velocity of money. And inside the fund, if we fully execute our value add business plan, by year 3, if there's a great opportunity to refinance or sell that asset, we could do that and then deploy that capital in another quality multifamily asset that checks all of our return and all of our criteria boxes. But if the market takes a turn, we want to be able to batter down the hatches and weather through the storm. And having that longer hold period really facilitates that. And again, just really removing the variable of time and just not forcing us to make a decision, but allowing us to make that decision to dispose of the asset to sell in the ideal environment is incredibly important.